name's Andrew Barnden. I'm a liquidator trustee from Rogers Reedy. Today we're going to be talking about protecting your clients from being personally liable for ATO liabilities. Very topical at the moment as the ATO ups its ante on its collection policy, issuing a lot of DPNs, Garnishee Notices, Statutory Demands for payments and winding up applications. Overview of what we're going to go through today. Company is a separate legal entity, the current insolvency landscape, ATO collection policies, director penalty notices, the two types, the non-lockdown and the lockdown, personal guarantees, breach of director's duties, and then our conclusions and recommended tips for everyone. So, separate legal entity, we're all accountants, lawyers in the room, all know, and a company is a separate legal entity. However, a lot of our clients, the directors, don't know that. A lot of them don't even, they just see it as their business, their company, their money. They don't understand that it's a separate legal entity under law. Normally, companies are set up for tax minimisation or limited liability asset protection purposes. However, the directors, as I said, are normally not aware of it. It carries a lot of responsibility to be a director, not only of companies, but also we're seeing a lot more of not-for-profit associations. Directors or board members of those are running into financial trouble and not understanding that they're on the hook for the liabilities of those organisations. Like I said, companies are separate legal entities, so normally the directors are not personally liable for the debts, but there are some exceptions, including taxation and superannuation debts, signing of personal guarantees, and breaches of directors' duties and insolvent trading under the Corporations Act. But before we get into all the personal liability, just have a look at, we'll go have a quick snapshot of what's happening in the current insolvency market. So corporate insolvencies, they're up, here we go, yep, they're up to 11,053 for the financial year 24. That's well above the historical average of 8,000 odd companies a year, but there was a lull during the COVID times and was significantly below that number. However, they're tracking at over 14,000 for the financial year. So the first 7 months of this financial year, there's already been 8,212. So they're on the rise. And why? Largely driven by the ATO, using a sledgehammer on a walnut. They are very aggressive at the moment. And we're starting to see the OSR come into play also with payroll tax audits. And that's everyone's chasing money and they're coming through. Which industries we're seeing recently have been affected, and that is construction. However, it's down from what it was 12 months ago. 12 months ago, it was well and truly the highest industry having issues. It's down, but it's still up there in the top 3. Food and accommodation services, with the cost of living, increased electricity prices, increased labour costs, it's all feeling the effects, and people aren't eating out as much and going cost. Just have a look. What used to be, you could go out for dinner, $30 used to be the top price you pay for the meal. You're now paying $40, $50 for a steak, and even more at some of the top-end restaurants. And what's been in the news is a lot of breweries, distilleries, wineries, and vineyards also. Again, they've been hit with the electricity prices going through, labour costs. During COVID, they had a bit of a peak period, purple patch. People were travelling locally, going to Orange, Mudgee, Hunter Valley, buying their wine. COVID's finished. People are travelling overseas, the ones that can afford it, or the ones that are still going to these wineries and that, they're going only buying 1 or 2 bottles of wine instead of buying a case or 2. Breweries, there's been so many craft breweries go under. It's not funny, but people aren't willing to pay $30 for a 4-pack of beer anymore. The wineries and vineyards are also, because they've got excess stock, they're running short on storage space. They don't want to convert their stock into cash at below cost prices, but they go have a point in time where they go have a new vintage coming in and they'll need to either get increased storage costs or dump some of their stock on the market. Also, what we're seeing, the restructuring in the number, the small business restructuring, now makes up a very good percentage of external administrations. In the small business restructuring program was brought in during COVID to give viable businesses a second chance. We've been doing a lot of them at Rogers Reedy. And touch wood, we've got a 100% success rate on getting those through. And then the ATO is pushing back down. Before it was about 20 to 25 cents in the dollar they were after return. It's now pushing up to that 25 to 33 cents in the dollar. But it's still a good deal when you have a look at it when total costs are taken into account. We're talking about 35 cents in the dollar, 40 cents in the dollar to clear the tax debts if the business is viable. And we keep coming back to that, if the business is viable. Otherwise, there's no point in doing a restructure because it's just kicking the can down the road. There was 11,000 odd companies that went into insolvency during last financial year. That was the headline figures that you saw in all the newspapers. However, it's not as bad as it looks when you drill down on it. It's only 3.9% of total companies incorporated. So we have a look here. The number of companies being incorporated are significantly growing and keeps on growing. So the number of companies that have gone into insolvency at 3.9% of total companies is still at the same level it was in roughly about 2019. So the headline number may not be as bad as it originally looks. On the personal side of things, there was 11,644 individuals that used the Bankruptcy Act last year. It was 17.3% increase from what it was the year before. However, AFSA, which is the government body that oversees all bankruptcies, has predicted a further 15% increase this year and another 12% increase in financial year 26. So there is a bit of heartache coming through the line. And again, we believe that will be driven largely by the ATO issuing director penalty notices, as well as some of the fourth and fifth tier financiers pushing on personal guarantees. Okay, I didn't know this until who said this phrase, that there's only two things certain in life, death and taxes, but Google told me it was Benjamin Franklin, so and it's still valid today. I've read the ATO 2024 annual report. No doubt all good accountants in this room has read the same. The ATO debt actually increased during 24 financial year, up 5.2% to 52.8 billion, despite their actual approach to collection. In addition, in October last year, they've announced that they're changing their collection policy via a press release, and they were saying it's changing their approach to collecting unpaid taxes and superannuation. Not paying taxes affect everyone. It is important that the ATO takes action to help prevent businesses from putting other businesses and individuals and employees at risk. It's making it fairer for businesses that are doing the right thing, and it's now focusing on businesses who refuse to engage with them and continue to ignore their correspondence reminders. So what does that mean? It means the ATO is getting more aggressive, doing a deliberate and targeted attack on those taxpayers with bad compliance histories. So basically, for those clients that aren't lodging or by the due date or soon after, aren't making payments of any type or aren't communicating with the ATO, they will be out there issuing and chasing up the debts. In that regard, the ATO issued 26,702 DPNs in last financial year, and they're on track to do the same again, if not more. Garnishee Notices. I had a guy before Christmas ring me, day before wages, his bank account got garnished by the ATO. And he said, "You've got to help me out, we've got to pay wages." And I said, "Well, there's nothing I can do about it. We can put the company into liquidation, but unless you've got money, it's gone." Saying that, it wasn't his first notice he got from the ATO. That had built up over a period of time, but he ignored it, and the Garnishee notice came in and wiped out his bank account. They're also issuing Garnishee notices to debtors also, if they're aware of them, to some of your clients' customers. So that could have a dramatic effect also. They're reporting to credit bureaus with debts of tax debts of greater than 100,000. 36,000 of those were reported last year, according to the annual report. And you say, so what? Report to the credit bureau. Well, that has a big effect on when you're applying for credit, the taxpayer's applying for credit, trying to seek finance for new equipment and bank rollovers. And with the banks rolling over the facilities, they look at these credit reports. So that has a big impact on that. Then they're moving into the statutory demands for payment, bankruptcy notices. and the winding up applications and bankruptcy applications. In addition, in Accountants Weekly 2 weeks ago, it was announced that the ATO is going to move their problem children from quarterly to monthly BASs. A bit more information came out late last week. They've identified 3,500 taxpayers they're going to be moving from quarterly reporting to monthly reporting on the 1st of April this year. And it's not an April Fool's joke, they've put it out there. And that's for those that they've identified that are missing payments or making no payments, lodging BAS or not at all, or lodging BAS late or not at all, or incorrectly reporting GST. So 3,500 will be moved from quarterly to monthly. So, as we said before, directors are normally not liable for the debts of the company. However, under the taxation legislation, the directors are personally liable for the tax debts of the company, namely superannuation, PAYG withholding, GST, including wet and luxury car tax. Now, they're liable as soon as they're appointed. They actually inherit all the tax debt when you become a director of a company or for a not-for-profit. The only way you can, if you inherit a tax debt, and the only way you can avoid personal liability is that if it's either paid within 30 days of your appointment or a liquidation administrator or a small business restructuring practitioner is appointed during that 30-day period. Even if you resign as a director, those debts are still attached to the director. If they were due and payable at that time. So keep that in mind. Any new directors, becoming a director is a big responsibility. So anyone's being appointed to a director, and it does happen. You say when you sell a business, for some reason you may just sell the shareholders across and change the directors in. You want to be very, very responsible on that and look at your liabilities there, and same for coming in for not-for-profit sporting clubs to make sure there's there. So like I said, you're liable as a director from as soon as you become. However, the ATO can't enforce it against the directors until they issue a director penalty notice and give you 21 days to do things. Two types of director penalty notices. The non-lockdown, which gives you 21 days to either pay the debt, and then that's pay the debt in full, not enter into a payment arrangement, or appoint a liquidator, voluntary administrator, or small business restructuring. Or they're the lockdown DPN, which locks onto the director and means that the director is personally liable and there's no way he can get out of that. And that's because they didn't lodge their BASs within 3 months of the due date. If you lodge your BASs within 3 months of the due date, it'll be a non-lockdown DPN. After 3 months, you've got a lockdown, and it's just a matter of time until the ATO pursues you. Now, the ATO is going back up to 6 years at the moment, issuing DPNs, especially for unpaid super, and even for companies that have gone into liquidation, chasing unpaid super and some of the tax debts that is attached. Also issue the DPNs, even though it's a joint and several debt of all the directors, they can pick and choose who they want to go against and who they issue the DPNs. We're up in Armidale last week, and one of the guys said he had a client that was jumping up and down that he got the DPN, but the other director didn't. And he said, of course you got the DPN because you disclosed you had 600 grand worth of income last year. They know that you're an easier target to attack them for the money. So they don't need to worry about who they attack, they just want the debt being paid full. So it is joint in several debt, but they can attack everyone, but they can't double dip. So if the director pays, the company's off the hook. Just be careful if you do get a DPN and you're making the payments, make the payment as per the director penalty notice to the individual's running balance account that's been set up as part of the DPNs. Don't pay it in respect to the company debt, because they may not match up, or you may have an argument to say which debt you're paying, especially if all the debts aren't included in the DPN. Now, DPNs, as I said, 26,000 issued last financial year, on track to do it again this year. It sounds common sense, but don't ignore these. But the problem is, according to the records from last year, only a third of directors took action who received a DPN. 2/3 did nothing. So keep that. But I don't have the breakup of whether they were even made aware of the DPNs. So the DPNs are based, the ATO will send it out to the ASIC's ASIC address of the director as per the company search. If it's a former director, they'll send it to their last known address, which is most likely the director's last tax return lodged. So if you know your client's moving house or moving state or buying a new property, make sure your records at ASIC are up to date so they get notices. As part of my, as the chairman of the Insolvency Management Committee at the Institute of Chartered Accountants, we have reached out to the ATO and asked them to issue any DPNs to the tax agent at the same time as issuing the DPNs to the directors. ATO response was, we don't, under the legislation we don't have to. But when we drilled down a bit further, it found out that their system couldn't issue to two different people for the one debt. But those with TaxMate, it'll automatically upload anything that's gone through the tax agent's portal. Otherwise, you've got to stumble across it when you're looking through the tax agent portal, and you might stumble across saying, oh, there's a DPN here, and hopefully it's within the time period. So you've got 21 days, like I said, the non-lockdown, you've got 21 days to do something. After you take, it's a day of it's issued. So after you're taking postage, especially the regional areas, you're less than 14 days from there to act on it. We had people in Orange yesterday saying that they've got TaxMate, they knew there was a debt there, been chasing the director. He finally rang them about 10 days in. He said, yeah, I got a letter from the ATO, I don't know what it means, I was going to see you about it in a month's time. No, then you need to do it now. Luckily, it's only a small amount, he can pay that, but these are the things that your clients are not aware of, that how guillotine they are and what the consequences are and how they can be liable. Moving on, like I said, other personal liabilities of companies that directors got to be responsible for, personal guarantees and breach of under the Corporation Act. Now, personal guarantees, we come across it all the time. You ask the director, who have you given a personal guarantee? Oh, no one. Oh, no one. We all know financiers, a lot of trade suppliers, anything with the banks normally want a personal guarantee. Be very careful. Some of the trade suppliers actually have a charging clause and see caveats put on houses for supplying of goods and materials. And these 4 for 5th tier lenders, the Prospers, the BizCaps, the on-deck finance that charge big interest rates, they also, they come across as saying that it's unsecured loans. Yes, it's unsecured against the company, but the directors give a personal guarantee and normally a charging clause against, and allows a caveat to be lodged against their house. They've got a sting in their tail too. They're looking at 20% interest before default interest comes in. Big dishonour fees, of daily dishonour fees. So it's not uncommon for some of these debts that are short-term money, breathing space for the company, to go from 50,000 to 80,000 in a very short period of time. So if any of your clients are using these 4th, 5th tier lenders, be very, very careful, because it's got a big sting in its tail if they can't meet the payments. Also, breaches under the Corporations Act. Section 181 to 183 are the civil sides, and Section 184 is the criminal. So 181, not acting in good faith and for a proper purpose. This is not only for directors, it's for all officers of the company. So it does include corporate secretaries, they fall under this. 182, improper use of position, and 183, improper use of information. I use these all the time as a liquidator when I'm bringing in a solvent trading claim or breach of, use a double barrel or triple barrel shotgun approach to bring in solvent trading, breach of directors' duties, and also Section 598 where it's any other person, especially if money's gone into joint bank accounts which aren't there for directors. ASIC is the one that will bring the 184, reckless and dishonestly acting in the position of a director. And then you're moving on to insolvent trading, Section 588G. Now that's a looking back perspective that a reasonable person in the shoes of the director should have realised that the company was insolvent or likely to become insolvent when they entered into the debt. So it's not the director's actual knowledge, it's what a reasonable person in the director's shoes and not worried about his education or training requirements, should have known based on all the information there. Did he have outstanding tax lodgements? Did he have big tax debt? Did he have outstanding super? Was employees chasing him for super? Was it creditors chasing him? Did he go on COD? So that's that reasonable persons test. However, there are defences, and the most common one put forward is the illness of the director or their immediate family, and they couldn't take control or run the company at that time. However, there was the issue of, well, why were they still a director if they were in that such a position? So keep that in mind. So we're rushing through this today because there's no questions, but we'll get onto that in a minute. Our tips and conclusion for everyone. ATO's out there. Don't ignore them. They chase anyone that is not lodging by the due dates, not making payments, and not communicating. If you do making some payments, lodging your BASs on time, and communicating, you'll go down the list. In addition, the ATO does have hardship policies, taking into account natural disasters. The cyclone up in Queensland will be used for a while yet. Serious illness of the directors and their immediate family. That can also put into account mental health and mental illness. It's a big ploy at the moment, big buzzword at the moment. Also, other factors outside the director's control. One of their major customers going broke and is causing a spiral effect. If you are making any requests to the ATO for hardship or anything like that, make sure you use those words, that you tick the boxes. There's talk that ATO is possibly using AI to go through GIC remissions and other things, and if they're not using certain words, it'll just get rejected. If certain words get picked up, it'll then move into a real person. That's the rumours going around. So the ATO isn't all bad, but they need to know the story. They want to know the story, that there's a reason why you're into this position, not just because you were lazy or forgot all about it, or the accountant has moved, or you moved accountants. So keep that in mind if you do want to communicate with the ATO. But by all means, make sure you lodge your BASs on time and are making some payments. Pay superannuation first and on time. If you don't pay super, it becomes an SGC. SGC is non-tax deductible. The directors are personally liable for non-payment of super. You might as well claim the deduction, have it going through, and getting the deduction for it, and reducing the director's exposure for that. Super is big on the ATO's collection policy. During COVID, people took out their $10,000 in each financial year. That's put a hole in it, and they're chasing it up. I know they are looking at changing to payroll, paying of super on payroll, but that's depending on which model you fit in. That may not come into 2026, but a lot of people are already doing that for a single touch payroll. But it is deductible. They're also doing audits on those with SGCs to make sure that you're not claiming it as a deduction. So keep that in mind. If you've got an SGC, do not claim it as a deduction in your tax return. That's once it's been paid, because you'll probably come under the spotlight. Lodge your BASs within 3 months of the due date to avoid the lockdown DPN. The ATO wants to know what the quantum of the debt is so they can work with you. If you don't lodge it, they think the worst. It could be twice as much or 3 times as much. So if you lodge it within 3 months of the due date, you will not. If you get a DPN, it will be a non-lockdown DPN, and will give you 21 days to avoid personal liability. And it sounds easy, but making sure people act when they receive any correspondence from the ATO. Director penalty notices, garnishees, statutory demands, bankruptcy notice, reporting to credit bureaus and winding up of bankruptcy applications. They are serious consequences, legal documents. Make sure directors act on that. In respect to the winding up and the statutory demands, make sure your registered offices are up to date. That's where all those documents will go. If you move premises, make sure you update all your registered offices that you have. If your client moves premises and they're acting as a registered office, make sure the records of ASIC are up to date, because they just have to issue it to the address at ASIC, because it's up to the company to make sure those records are correctly maintained. And like always, seek professional advice. Sam is always out and about around the Central West and Northern New South Wales. He's only a phone call away, so am I. Obligation-free. The initial advice is to put your client's mind at rest or in a path that we can deal with the matter, but ignoring it is not an option, because if you ignore it, as I keep saying, a good analogy, if you bury your head in the sand, it means your bottom's up in the air, which means it's going to get kicked sooner or later, and it gets kicked hard by these things. Is there any questions, any comments? Has anyone seen a DPN recently? Yeah, Clint's saying yeah. Were they lockdown DPNs or non-lockdown, or? And a lot of people don't know the difference between lockdown and non-lockdown. It's only the last page of the letter where it says you've got 21 days to do one of these things. And by the time they get them, as I said, it's 14 or less days to act. They are bringing in the traffic light system for professional services and trusts, and the allocation of income, but I don't know about trust in general from the ATO. Trust isn't a separate legal entity. It's a weird legal terminology. It doesn't have an existence. The trustee does, but the trustee's got the right of indemnity against all the assets of the trust. So they normally wind up the trustee company and the corporate trustee, which then can have the right for indemnity against those assets. The trustee may make it a bare trust if under a liquidation scenario, and in certain circumstances the liquidator will be making an application to the court to be appointed as receiver and manager of the trust to realise those assets if need be.